Bypass the middleman, your bank.
So in 2008, when the federal government saw 400 banks go under, 900 more on the watch list, they asked the 5 major banks to disclose where they had their tier 1 assets for liquidity and safety. And 30 to 40% of it was in insurance companies. Whenever I need working capital, I borrow from an insurance company and they loan me money based upon how much money I have on deposit. And people say, well, why don't you just withdraw your money? Because that's not smart. Do you understand what I'm talking about when you double dip? You can be making money on your money while you're using your money to make money.
In this educational episode, I'm going to teach you, and hopefully you'll teach your adult children, how to preserve and compound wealth by simply putting it where banks put money. Becoming your own banker is sometimes what I call it. This will blow you away. Get ready. So I'm Doug Andrew. I've been a financial strategist and retirement planning specialist now for 5 decades, helping thousands of Americans optimize their assets, minimize taxes, and empower their authentic wealth. I've been very blessed and honored thus far to have authored 12 best-selling books. And I have many more in me. I'm so grateful for the receptivity. On this YouTube channel, I have over 1,100 educational YouTubes as of the recording of this episode. And I'm so grateful for all of the subscribers who come to this channel to learn. So let me give you a few insights on this particular topic because I'm very concerned about the next generation. And I think we as parents need to learn financial strategies and then help our children so that they don't make the same mistakes we did. Because so many times I'm talking to baby boomers and they're getting ready for retirement and they always go, wow, I wish I would have known this information 20 or 30 years ago. Well, then teach your children this so they don't just follow the herd like you did, putting money in the company's 401k, being told you're going to be in a lower tax bracket when you retire. And that didn't happen, right? Okay. So let's go back and talk about the history behind why I believe a maximum funded insurance contract, when it's structured correctly, it's deemed a laser fund, why it's my favorite instrument. So as far as safety is concerned, in the Great Depression, let's go back to that period of time where the banks closed. Now, 40% of banks back then never reopened their doors. They permanently closed. Some real estate dropped in value 80% in the Great Depression. Do you know who came through the Great Depression with flying colors, paying 3.5% interest on the money on deposit with them? The multi-trillion-dollar legal reserve insurance industry. Okay, it's called legal reserve because they have to have reserves on hand legally that are far more stringent than banks and credit unions have to have on hand. In fact, most banks and credit unions have a lot of their tier 1 assets. Those are assets that have to be on hand, liquid, and safe in case of a run on their bank. They put that money in insurance companies. That should tell us something. And that was revealed in 2008. See, in 2008, because of the market crash, many people lost 40% for the second time in a decade. None of our clients lost a dime in 2008. In fact, many of them were almost like cheering. Go, because they weren't losing when the market went down 40%. They may not have made much of anything, but they didn't lose. And you know, most of our clients, the first 90 days of 2009 locked in gains of 16% tax-free after not losing a dime. Most Americans, it took 4 years to make back what they lost in 2008. At the end of 2012, many of our clients had doubled and tripled their money tax-free compared to people who, for 12 years, they saw $1 million nest egg go down to 600,000 twice and barely come back to break even. This is significant. And I think in the future, we're going to continue to have market volatility. So in 2008, when the federal government saw 400 banks go under, 900 more on the watch list, they asked the 5 major banks to disclose where they had their tier 1 assets for liquidity and safety. And 30 to 40% of it was in insurance companies, usually in the form of BOLI, that's bank-owned life insurance. People say, what? Banks own life insurance on who? Doesn't matter. It's the owner of the insurance contract that gets all the tax-free growth and tax-free income and what have you. I have seen many corporations, they use COLI, C-O-L-I, corporate-owned life insurance. And so this is where banks had their tier one assets for liquidity and safety. Now, what a lot of people don't realize is that banks in 2008 were paying less than 1%. Let's give them the benefit, 1%. Every $1 million they borrowed of OPM, other people's money, they paid 1%, that's 10 grand annually. They turned around and put it in insurance companies, and without even linking to an index, they were earning 5% back then. That's 50,000 on every million. How much more is 50,000 than 10,000? Don't say 40,000. It's 500% more. It's 5 times. Okay. And I've often asked on various episodes, hello, would you hire an employee for 10 grand that made you an extra 50 grand? That would be a 500% return on employment cost, or equipment cost if you bought a widget machine for 10 grand that made you an extra 50 grand. I'm just talking about how you can become your own banker. And I think we should teach our children this so that they will not outlive their money. So this is about preserving and compounding your wealth. When we talk about how banks make money, if they stop paying interest, they would wither up and die. A lot of people don't realize a bank or credit union's greatest asset is their liabilities. Okay, and so if they stop paying interest, they would stop making money. But they pay interest at 1%, 2%, or 3%, so they can turn around and make 5%, 6%, 7%, or 8%. And that spread, it's called an arbitrage, is what makes the world go round. You can do that with your own money in the laser fund. And so, for example, I have a lot of business clients who use the laser fund not only for their retirement, but they use it as a working capital account for their business. And so they bypass the middleman. Instead of having their working capital in some bank earning a measly interest rate, they want to outpace inflation. So they keep their working capital in a properly structured max funded IUL laser fund. So let me give you an example. They do what I do. Whenever I need working capital, I borrow from an insurance company and they loan me money based upon how much money I have on deposit. And people say, well, why don't you just withdraw your money? Because that's not smart. Well, what do you mean? Why would you pay interest to borrow your own money? Because if I need $1 million out of my laser fund and I withdraw it, it's no longer there earning interest. And I've been averaging, 8, 10% or higher. Let's say 10%. If I took out or withdrew my $1 million, I would give up 100,000 of interest that I would be earning if I left it there. Well, yeah, but if you borrow it out, you're going to be paying interest. Yeah, but hello. They will give me what is called a zero cost loan. I can borrow the money at 2%. That's 20,000 on $1 million. And they'll credit me 2% on the $1 million that was collateral because the insurance company is loaning me money based upon my cash value that is collateralizing the loan. My money is the asset backing the loan. But I don't do that. I use the index loan, and so do most of my savvy business owning clients. So I may use an index loan where I agree to have them charge me 4% or 5%. What? Why would you agree to be charged 4 or 5% instead of 2%? Because now they'll credit me not just the same rate they're charging me to be a zero wash loan, they'll credit me the actual indexing rate for that year. You wouldn't believe how many times I have borrowed money, 100,000 or $1 million or whatever, at 5%, and that year I got credited 10. How much more is 10 than 5? Don't say 5. It's 100% more. I'm gladly paying 50,000 in interest to make 100,000. So I came out ahead, and I was still using my $1 million in my business to make money. Let me blow you away with this example. I had a business owning client who has done this for years. In 2017, he felt bullish about America. He needed $1 million to tie up I think it was a strip mall or an apartment complex that was 17 or 18 million dollars, but he needed $1 million of earnest money. He called up and said, Doug, I need to borrow $1 million out of my policy. He didn't say withdraw. He knows. But he says, send me that form. Now, he knows the form. It's 1 page. He puts his name and his policy number on it. And it says, do you want to borrow or withdraw? He checks borrow. And it says, do you want to use the zero net cost loan or do you want to use the index loan? He goes, index loan. So that year, they charged him 5% on $1 million loan on his policy. They charged him 50 grand. Does he have to write out a check for that? No. It's automatically deducted from the interest he's earning. Guess what he got credited? 25%. He capped out at 25% that year on his policy. He made $250,000 minus the 50,000 of interest, he netted 20% or 200 grand on his million, while he was technically using that million in his business to buy up a property and fix it up and flip it and make like 3 million. Do you understand what I'm talking about when you double dip? You can be making money on your money while you're using your money to make money. I say that, and sometimes people get a deer in the headlight look. If this is resonating with you and you want to learn how to do this so that your money is in a position of liquidity, safety, earning predictable rates of return, sometimes 100%, 200, 300% or higher than the net cost of the funds, I like to put my serious cash in the last domino, in my opinion, that would fall. If we had a total financial collapse in this country, and we came close to that in 2008, that's why David Walker, the Comptroller General for the General Accountability Office, resigned, because Obama would not let him tell the truth, is what the news reported. He wanted to tell Americans, hey, things are really, really bad, and they didn't want to create a panic, but anyway, he resigned. He is a big proponent of a max-funded indexed universal life policy, and one of the reasons is because it's the last domino that would fall. If we had a total financial collapse in this country, okay, now if things got that bad, first of all, the banks would begin to go under, and you're going to see some regional banks go under because commercial real estate is 30 to 40% vacant, and they are having to refinance about $3 trillion of it in the next 24 months. Regional banks hold most of the mortgages on those, and the landlords can't afford to pay higher interest. The interest rates are double, and they can't afford to do that. And so they're going to get a whole bunch of inventory, and they're going to liquidate that. And so the price of commercial real estate is going to go tumbling down. That also has a ripple effect to a lot of other businesses. So if that gets really, really bad and ripples, it can cause a lot of other industries, real estate and banks and credit unions, everything like that. Well, if things got super, super bad, the last domino that would fall would be the multi-trillion-dollar legal reserve insurance industry. And frankly, that's where banks and credit unions have their tier one assets for liquidity and safety in case there's a run on their bank. So I've been teaching people for years, for your serious cash, bypass the middleman. Don't put your money in banks. Don't put your working capital in banks. Put it in insurance companies and structure it so it's 100% liquid. You can access it anytime you need it. It's safe, not only safe from loss of your original principal due to market downturns, but every year you make money, that becomes newly protected principal. You don't lose in future years money you made in previous years. A lot of advisors don't know how to do that. And then you're earning a predictable rate of return that historically has outpaced inflation. So you do that with your serious cash, and you will not only preserve your wealth, but you will compound your wealth as you continue to earn a rate of return much greater than the net cost of the funds. Now, this has been a lot of information. Maybe you feel like you're drinking out of a fire hose. Well, if you want to take it in bite-sized chunks, I would recommend that you study my book, The Laser Fund. This is a 300-page book, but it's actually two books in one. This side is for the left brain learner that learns by the charts and the graphs and the percentages. Now, if you're a right brain learner and you learn more by stories, the metaphors and examples, you flip it over and read this one. This one's about 200 pages. This one's about 100 pages. If you want to use both your right brain and left brain, you can read all 300 pages. The point is this. You can begin to learn how to diversify and create the foundation for a tax-free retirement, how to become your own banker, how to preserve and protect your wealth, and have your money in the last domino that would fall. If that fell, the American dollar would be worthless. You ought to be able to grow carrots in your backyard to survive. And so there is no secret place that's going to survive everything, but I'm not a doomsdayer, but I am a realist. I think things are going to get rough, and I keep my serious cash in the best instrument that passes liquidity, safety, rate of return test with flying colors, and it's tax-free to boot. So go to laserfund.com. You contribute a nominal amount towards the shipping and handling. I'll cover the rest of that cost. I'll pay for the book. I'll fire out a hard copy. Now, while you're in there, claiming your free copy, if you like to listen and learn or watch and learn, there's formats for that. Check out some of the free educational webinars that we do on a regular basis. You can even schedule an appointment to talk to an IUL professional that's certified so that they can show you how any of these strategies may apply in your particular set of circumstances, and you will know that it is being done correctly. I could tell you horror stories of people who went down a dead end for 5, 6, 7 years with an IUL policy that was not structured correctly. And they missed out on hundreds of thousands of dollars because the advisor didn't know what they were doing. Make sure you talk to somebody who knows what they're doing.